Press the bell icon on the YouTube app and never miss another update.
A company prepares its accounts annually on 31st March each year. On 1st April 2014, it purchases a machine at a cost of Rs 1,50,000. The machine has useful life of 3 years and an expected scrap value of 0. It is eligible for 100% first year depreciation allowance for tax purpose. In accounts, the depreciation will be 60, 50, 40 in years 1, 2 and 3 respectively. The corporate tax rate is 40% each year. Compute deferred taxes for each of the 3 years arising due to depreciation. We know that the very first step of accounting standard 22 is you compare what you are doing in your accounting books and what is actually allowed for taxation. And we know that at so many places there is a difference between what we do in our accounting books and taxation. It is those differences which brings about a difference between the accounting profit and the taxable income. These sources of differences are then classified into permanent differences and timing differences. If it is a permanent difference, we have to ignore it. If it is a timing difference, we have to recognize deferred taxes on it. Depreciation is nothing but a timing difference. As you can see, the cost of the machine is 1,50,000. Now, it is eligible for 100% first year depreciation for tax. So in tax, I will claim depreciation of 1,50,000. And in accounts, I will say it is 60,000, 50,000 and 40,000 in 3 years. But if you take a total of 60, 50 and 40, you will realize that in accounts also the total is 1,50,000. So year-wise depreciation is different, but over a period of 3 years, the depreciation is the same. Year-wise year, it is different. That's the reason we say it is a timing difference. If it is a timing difference, it will result into deferred taxes. Let's see what will be the deferred taxes. So please give the heading in your books, computation of deferred taxes. Give the heading, computation of deferred taxes. Yes, 3 years are there. It says on 1st April 2014. So we say 2014-15, 2015-16, 2016-17. Now in accounts, your first year depreciation will be 60,000, while in tax, your first year depreciation will be 1,50,000. So in the first year, wherever there is a higher figure, that should be our starting point. In the first year, the higher figure is for tax. So I will start from tax. I will advise you to see the entire calculation, and after that you can pause the video and copy it down. Use this as an opportunity to understand how the computation will be done. Okay, so don't be in any hurry to write it down. The first thing that we will do is we will say depreciation for tax. In the first year itself, I will claim entire cost. Then I say depreciation in accounts. $60,000, $50,000 and $40,000. The difference between the two amounts of depreciation will be your timing difference. So C, we say timing difference. That's your A minus B. 90,000, negative 50,000, negative 40,000. Right? Basically, this is 0. So 0 minus 50,000 and 0 minus 40. And this is 1,50,000 minus 60. So that's my timing difference. These timing differences should be added. This will give you cumulative timing difference. this will basically demonstrate that how the timing difference is reversing itself. How will I do it? Just see. 90,000, to that I will add 50,000, and to 50,000 I will add 40,000. That is how the totaling will be done. Right. So cumulative timing differences. Here I say 90. Now I will say 90 plus this particular figure. So it turns out to be 40. And to 40 I will add this figure. So it turns out to be 0. You may even put a dash over there, it is fine. So I get my cumulative timing differences. Add up the timing differences. So basically what this shows us that in the first year there shall be a timing difference, and over a period of 2 years the timing difference will reverse itself. By the time it is the third year, the timing difference has completely reversed itself. Okay. Now apply the tax rate. Tax rate is 40%. So cumulative timing difference will be multiplied by the tax rate. This is what is going to give us the deferred taxes. Now is the most important step. I have to identify the nature of the deferred tax. Is this a deferred tax liability or is this a deferred tax asset? So when I multiply the two, I will get the deferred tax. It is as simple as this. I will multiply these two figures, these two figures, these two figures, and I will get deferred tax. But I will have to write over here, is it a deferred tax asset? Is it a deferred tax liability? That's the most important thing to be done now. How will I judge whether it's a deferred tax asset? Is it a deferred tax liability? Ask yourself, and this is an important question. Because of the timing difference in the current year I will call as the first year. Because of the timing difference in the first year, are you paying more tax or are you paying less tax? If you say I will pay more tax, that means in future you will save tax. If you are going to save tax in future, then it is a benefit. It's an asset. Recognize deferred tax asset. Or the other thing is that in the current year you are saving tax, but in future you will have to pay more. You will be liable to pay more in future. And if you will be liable to pay more in future, recognize deferred tax liability. So let's rationalize the entire thing. What do you say? In the first year, depreciation for tax will be 1,50,000, but in accounts it is only 60,000. That means for income tax, you are claiming 90,000 rupees of extra depreciation. For income tax, your depreciation is higher. Tell me logically, put it logically. In income tax, your depreciation is higher by 90,000 rupees. Higher depreciation for tax means lower taxable income. Lower taxable income means you will pay less tax. So in the current year, you will pay less tax. You know, in current year, you will be extremely happy. You will be like, okay, I've saved tax in the current year. But let me tell you, the income tax department will catch you next year. What will happen next year? In next year, for income tax, there is no depreciation at all. So for tax, no depreciation in the next year. Next year, no depreciation for tax means higher taxable income. Higher taxable income means you will end up paying more amount of tax. So tell me, what is happening? In the current year, you are saving tax, but in future, you will be liable to pay more tax. Payment of tax is getting postponed. The liability is already crystallized. I will have to recognize a deferred tax liability. So when I will multiply these two, I will get deferred tax liability. So I say here deferred tax liability. Okay, call it as, in short form we say DTL. So I'll say deferred tax liability. Again in brackets I say I'll get a closing balance. And how will I get it? D multiplied by E. So 90,000 I will multiply by 40%. So 36,000. This is 16,000. This is 0 or nil, whatever you say. So you are getting the closing balance of the DTL. Okay. Now I will say opening DTL. Opening DTL. This is the very first year, so it does not have any opening balance. For 16,000, the previous will become the opening balance, and here 16,000 will become the opening balance. So this gives us DTL for the year, F minus G. 36,000 minus 0, it is 36,000. This is negative 20,000. This is negative 16,000. 36 minus 0, 16,000 minus 36, 0 minus 16,000. So as you can see, the total of these two is turning out to be 36. This is known as DTL recognized. This is known as DTL reversed. In the first year, I will recognize the DTL of 36,000, and in the next 2 years, that 36,000 will reverse. Indirectly, what we are trying to tell is that in the first year, we are seeing that, see, in future, I am liable to pay 36,000 rupees of extra tax. So I am recognizing a provision for the extra tax. And then this extra tax will be ultimately paid in the next year and the subsequent year. So when I pay it in the subsequent years, whatever provision that I have recognized, I will reverse that provision. So in first year, I accept the fact that I will pay extra 36,000 in 2015, 16, 16, 17 together. And then as we pay that extra tax, our DTL gets reversed. Yes, you can pause the video now and complete your solution.
Press the bell icon on the YouTube app and never miss another update.